Hey fellow investors, what if you could invest in some of the best performing stocks on both Canadian and US market? Combined together, they almost doubled their benchmark. That's kind of crazy, right? But those performances exist. Actually, at Dividend Stocks Rock, we have a pro membership where more than 2,000 seasoned investors are using our platform to build their portfolio and get a customized report. So every quarter, they know exactly what happens with their companies, the latest earnings news, the dividend growth, the weak stock, the good stock, some replacements, everything in one report. What it enables us at DSR is to also pull out the top 10 most popular stocks for both Canadian and US companies. When we put them together and we compare to the benchmark, which is AFXIU and AFSPY, so AF Canadian, AF US market, it is amazing the return that we can see. Today, I want to share with you 4 of the top 20, and at the end of this video, I'm going to tell you how you can get the full 20 stocks. For each stock, I'm going to tell you a little bit about their business model, a little bit about what I like, and a little bit about what I don't like, because unfortunately, no stocks are perfect. So let's start with the most popular stocks across the entire platform, with more than 1,000 members that have it in their portfolio. The company is, drumroll, Telus. Telus is almost a pure play on the wireless industry, so a little bit different compared to Rogers and Bell, because those 3 companies together, they control about 90% of wireless segment in Canada. The difference is Bell and Rogers also have a lot of revenue coming from wireline, cable, internet, and obviously a lot of the media business. But Telus decided to take another pathway. So on top of focusing on wireless revenues, they are also expanding with technology. This is actually one thing that I really love about Telus, and it's diversification. They have Telus International focusing on artificial intelligence, and they are also expanding throughout agriculture and healthcare segment, helping farmers and healthcare specialists to manage their business, which is a very interesting play because we're pretty far from the regular business model where you produce content and then you find ways for clients to get a subscription and get it at home or on their mobile phone. Telus is using its high cash flow generating wireless business to finance its other segments, and it opens the door for many opportunities. When you look at the dividend triangle, Telus is showing strong revenue and dividend growth over years after years. Actually, it's the best dividend grower in this industry. Unfortunately, nothing is perfect. On the other side, this is the type of company that is capital intensive. Telus saw its debt going from 13 billions in 2018 all the way up to 18 billions in 2022, which is kind of scary considering that interest rates are going higher and higher right now. The other downside that you can find at Telus is, while it is a great narrative to see those new segments developing, we don't have much information about their revenue growth and their earnings, and it's pretty much still buried inside annual statements. We don't know exactly if it's going to be huge growth vectors for the future, so it sounds promising, but it has not moved the needle yet within the business. Finally, Telus has a great balance between yield and growth, so it could please retirees and also growth investors at the same time. Now moving on to another very popular Canadian stocks. This one is actually trending among the DSR community as it becomes more and more popular, and it's Algonquin Power. Algonquin, probably the reason why it is so popular these days is because the stock price crashed, and there are a lot of good reasons for that. We're going to get there in a moment. But in the meantime, it pays a very generous yield right now. So Algonquin is 65% regulated regulated assets. We're talking about a utility business, electric transmission, classic business, and then the other 35, it's focused on renewable energy. The company grows by acquisition. They went from about 100,000 customers and now they're up to more than 1 million within the last 10 years. So the process they use is they call it the greening process. So they will buy a lot of utility assets and they will get that monopoly over that state or that region. And then they're going to start to increase the renewable energy production within those states. It's a great business model that has been proven to be quite successful in the past. The company is quite oriented towards growth. They increase their dividend year after year. Even in 2022, while the stock price drops, actually the dividend increased by almost 6%. And if you have a condo in Florida, that could be something interesting for you. Algonquin is paying its dividend in US dollars. Therefore, you benefit from a strong currency. Unfortunately, nothing is perfect for Algonquin. One of the reasons why the stock keeps going down for the past, like 18 months now, is they issue a lot of shares and they get into a lot of debts to finance their mergers and acquisition. So it's always an exciting narrative to see a company growing that fast. But the problem is, now that interest rates are going higher and now that the company is continuing diluting the value for shareholders as they issue more shares, it becomes more and more difficult to prove that the next acquisition will be profitable. Last year, they announced they will buy Kentucky Power for over $2 billion transaction, which is a lot of money. So investors are starting to get concerned. They're a bit nervous. On my side, I do have it in my portfolio. I saw an opportunity when I saw the stock going down. Obviously, I should have waited a little bit more, but in the meantime, I'm happy with the dividend. Since management announced a dividend increase in 2022 as well and shows no sign of slowing down in terms of future dividend growth policy, I am confident that over time it will turn around. And if they can prove they can work their magic with Kentucky Power, the stock price will go back up. Obviously, probably definitely a riskier play compared to Telus. So now let's move to the US border for the next two most popular stocks. Let's talk about Microsoft. I've been talking about Microsoft a lot on Twitter and on this channel as well, but this is because this company is just amazing. They have this strong bond with corporate America, offering them plenty of software throughout subscription business models. So which is great now is all the businesses, they're just paying every year to use the Excel suite, to use Windows, to use Dynamics 365, all of those software that basically I am a business owner and I would not be able to work without Excel. And I'm pretty sure it's the case for a lot of people. Microsoft also have another very interesting segment, which is the cloud business. Cloud business, especially with Azure. Azure, that is the second largest public cloud service behind Amazon. It's still growing double digit. Last quarter, we were up 35% in terms of revenue. Maybe a bit disappointing compared to what we have seen in 2021, where it was almost doubling in revenue year from year, but still it is a lot of growth coming from the cloud industry. And finally, they have a very well-established foot in the personal computer. They also have a lot of interest in the gaming world. They're trying to buy Activision Blizzard, which put them as the number 3 largest player in the gaming industry. That would be just huge, but we have to wait for regulators on this one. Again, there's some downsides to Microsoft. The first one, we see it in 2022. There was such a hype around the stock that it started to trade around 35 PE ratio. Now it's back down to roughly 25. I think it's interesting, but still the market is expecting a lot. During their latest quarterly earnings in October, they reported double-digit growth across most of their businesses, and yet the market was like, 35% revenue growth for Azure? That's not enough. We wanted 500% growth. The investors are becoming greedy. The hype is slowing down, so maybe it's going to be a rough time for Microsoft to convince investors that they're still growing, but I mean, they are double-digit growth. like year after year. They increase their dividend like there's no tomorrow. On top of that, they generate so much cash flow. I really wonder why it's still not a darling in 2022. Let's close this up with a classic dividend grower, a dividend king, a company that we all know, Johnson&Johnson. I'm not going to tell you the rank among DSR members, but it's part of the top 10. It's a classic, pharmaceutical, medical device, and also some consumer products. Some investors think that Johnson&Johnson is all about making Tylenols, which is about like 15% of their sales, so it's not that much. The big part is actually pharmaceutical. So their drugs are selling for about like 55% of their entire revenue. One thing that I really like about Johnson&Johnson is, when you look at big pharma, the thing is always about patents and expiry. And then whenever they develop a drug, they run on it for a while. And after that, when the patents expire, sales drop, profit drops, and it becomes a bit concerning. With Johnson&Johnson, they focus on specialty drugs, which are harder to replicate. This means that even if the patent expires, it's going to take a longer time for generic drugs to come on the market, which gives them a little bit more time to rack up some sales, make some profit, and make their investment more profitable. The fact that you can count on Johnson&Johnson to increase their dividend no matter what happened on the market for more than 50 years now shows that it's a resilient business model. So high interest rate, not a problem. Recession, not a problem. Consumers are worried about this and that, not a problem. Johnson&Johnson is there to stay, and it's there to help you reach your retirement goals. Unfortunately, Johnson&Johnson, since they are part of the pharmaceutical business, they're also exposed to lawsuits. We have seen that in the past, not always a fun thing. Lawsuits create a lot of uncertainties. It could be costly as well, so you have to be careful on that part. And finally, in terms of drug development, while they have a great history developing a strong drug pipelines, it's always a bit of a hit or miss when we're thinking about blockbusters for drugs. So again, we could run into a slump where like 5 years consecutive that there's nothing being generated there, and then Johnson&Johnson could go sideways. So again, not a perfect investment. So now, how can you get access to the top 20 most popular stocks at Dividend Stocks Rock? I'm actually going to do a full webinar on those. The webinar is 100% free, and you are welcome to join. Link right there in the description below. If you are late for the webinar, don't worry, there is a full replay. So you just click on the link. You either be able to register for the live event, or you're going to watch the free replay afterwards. I'm going to talk about all of those. You're going to receive them in an Excel spreadsheet with all of the financial metrics that you can go through and see. Some of them are quite interesting, actually. They pique my curiosity. They're not all my favorite stocks. Some of them have greatly outperformed the market. Some of them not so much. You have like growth, you have high yield, you have pretty much everything for any kind of investors. And I think it would be a great start for you guys before 2023 starts. You'll be able to build your buy list, do some research during the holidays, and get ready for January. So don't forget to sign up. Let me know about your favorite stocks. Actually, it could be a great conversation that we can have, which kind of stock that you prefer in your portfolio. And until the next video, don't forget to stay invested.